So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swarts, and welcome to Capital Gains Tax Solutions. Brett Swarts here, Capital Gains Tax Solutions. Excited for our next guest, Irs Naugle. He is on a mission to be America's #1 money mentor, a financial advisor, real estate investor. He syndicates deals. He does fix and flips. He's been on TV. He's been featured in Forbes, HGTV, ABC, House Hunters. He's just going to deliver an action-packed content here in the next 30 minutes. It's a little bit longer show, but tons of meat and tons of value he's going to add. I hope you enjoy the show. And with that, here is me and Chris on the interview. Welcome to another episode of Capital Gains Tax Solutions podcast, where we believe having a plan that's been proven to help you defer capital gains tax is the best way for you to create and preserve more wealth. I'm your host, Brett Swarts. In each episode, I'm joined by some of the top financial experts, real estate experts, here to bring their knowledge and wisdom and share their stories of inspiration, deal stories, as well as capital gains tax deferral strategies they use, all so that you have each of the solutions and have more clarity on what might be best for you. Our current episode right now is no exception. This next gentleman has dedicated his life to being America's #1 money mentor. His success includes managing over $30 million in assets as a financial advisor in financial services, and also tens of millions in real estate business. And he has over 200 transactions that he has done as an HGTV pilot show since 2014. He's also a very well-known speaker, has an amazing podcast, and he is currently the co-founder of Flip Out Academy, as well as the founder of the Money School and the Money Mentor and for the Money Multiplier. He has a new book that's actually going to be released here on April 1st called Mapping Out the Millionaire Mystery. And we're going to be talking about that here on the episode, along with being featured in Forbes and ABC and speaking to over 10,000 Americans. Chris is going to share some knowledge with us right now. Hey, Irs Naugle, welcome to the show.
Awesome. Thank you for having me on. I appreciate it.
Excellent, Chris. Maybe you can share a little bit about your little bit about your story. Give a brief overview of your story, and then also your current focus right now.
Sure. I mean, my story, I'll just keep it really simple. I mean, I grew up in a very humble household. Dad was an alcoholic. Mom had to raise me. Barely had anything growing up, but she always made the best of it. And because we didn't have any money, I always had to hustle and go out there and do whatever it took to make things and to, whatever I wanted to buy, I had to go work for it. So I worked on farms, shoveled driveways, and did that. And that's just how I grew up. And then until I was 16, I didn't even realize that wasn't the norm. That was just the life I lived. So it was just the norm for me, but not the norm for everybody else. When I started working at this restaurant, I realized that other people had different luxuries that I didn't. And I remember that restaurant, they degraded me so badly that I ended up quitting. And I came home to my mom and I said, Mom, I'm never going to work for anyone again. I want to start a clothing line in the basement called Fat Clothing Company, PHAT. And that's where my entrepreneur background began. So at 16, I opened Fat Clothing Company, which I'll get to Fat Man Board Shops. And it was a clothing line that I did, a skateboard, snowboard shop and clothing. I would take that clothing out as I was trying to be a pro snowboarder, and I would sell it to all the shops. And while I was doing this, I started thinking, man, these guys got it made. They got their own stores, their lifestyle business. I need my own store. So that began at 17, my infatuation with wanting to have my own store called Fat Man Board Shops. Well, when you don't grow up with any money, you don't really know any people with money. So I went around and I asked everybody for the $70,000 that I needed, and I got told no by everybody. And I almost gave up. Then my mom didn't want me to fail, didn't want me to not follow my dreams. So she had the house that she got in the divorce, and it had exactly 75,000 in equity. So she put the house up. So her crazy 17-year-old punk snowboard kid could chase his dream and open Fat Man board shops. So now I'm 17. I actually had turned 18 at this point, and I had this retail store, $70,000 in debt, mom's house on the line, and here I was, knew nothing about running a business. Fast forward from that, everything went really well. I went on to be a pro snowboarder. I ran these stores successfully, opened several different locations, all the way up to the early 2000s. I was doing quite well. I mean, I kind of was like living the dream. I had my pro snowboarding career. I had my retail stores. I had my crew and my managers. And then the planes hit the towers in the early 2000s. Well, I'd never been through a recession. Much like a lot of the millennials today, they don't remember the Great Recession in 2008. All they've seen is this upward market, right? This good time. Well, that's all I'd seen up to this point. And what happened is my retail stores took a big hit, and I had to go get a job. That job ended up landing me as a financial advisor. Now, this was supposed to be a temporary thing, right? Either deliver pizzas or be an advisor. I know that sounds weird, but that's how I looked at it. I was just either there was that, and then once I got through this little rough period, I could go back to my life of being a shop owner and a pro snowboarder. But something weird happened. I ended up loving the snowboard. I love snowboarding, but I ended up loving the advisory, and I was really good at it. So I started excelling, and I became one of the top advisors. And during this process, it forced me to not work in my stores, but work on my business. And I turned over a lot of the responsibilities to my managers, and they did a great job. And as this went on all the way up to 2008, I was crushing it. I'd started flipping a couple houses because I, just like many, watched a show on, it was actually A&E back then, about flipping houses. And I'm like, I got to do that. That looks like a great way to make money. And first flip was 06, and things were great. By 2008, I had my next great idea, and that was I wanted to open a big retail shop, like a shopping mall. And there was a dilapidated building, so I bought that building with private money. Borrowed money from the wrong guy. His name was Knuckles, nickname. And you know what happened? 2008. I had no idea the recession was coming. Had no idea. I was just going full steam ahead. And when that recession hit, it brought me to my knees. It literally crushed me like a Mack truck hitting me at full speed ahead. And I got to being one payment away from being completely bankrupt. And that guy Knuckles, I remember when I said, hey, I'm having a hard time with these payments. Can we do something? Well, I'm not going to tell you what the answer was, but it was one that scared me enough to say, okay, Chris, guess you're not going to be sleeping much, and you're going to be working all night to finish this thing. So how I got through this time is I came home one night. My girlfriend, who's now my wife, had just moved in. And I remember looking her in the eyes, and this was really hard for me. I looked her in the eye and I said, sweetie, I need your help. I need your help paying the mortgage. I need your help paying the utilities. And by the way, that bedroom down at the end of the hall, we have to rent that out to my friend Pete because I can't make it. I'm going to lose it all if you can't help me do this. Now, I knew it was a 50-50 shot. She was either going to walk out the door and say, I'm not dealing with this, or she was going to stay. And I think she kind of liked me because she stuck around, and we ended up getting married. Because of that, I made it through that time. And as soon as I got through that time, right after that, I was always a good investor. You know, I was an advisor, and I loved Warren Buffett. Buy low, sell high, and don't lose money. Well, in 2009, everything was on sale. So I started buying real estate. So from 9 to 14, I bought 36 apartment units, pennies on the dollar. And it would seem like, you know, I was crushing it again, but I wasn't. You see, I was actually buried. And then the banks decided, when I brought them the 37th deal, they said I didn't fit the little square box anymore, the little debt to income box. Nope, I didn't fit that. So they froze all my lines of credit, and I had to sell all 36 units. But that wasn't the worst part. You see, what I also had to sell was the dream house that me and my wife, she was now my fiance, but she's wife today, that we had bought. We had to sell that dream house. And at that point, I wanted to quit. I was done. Like, there's just nothing left for me. And then at that point, I decided I needed help. And that help came in the form of a postcard to go to a 3-day seminar to learn how to flip houses. Now, no two ways about it. Don't even think for a second I was going to this seminar to learn how to flip houses. I was going to this seminar because I had nothing to lose. And by going, I was getting an iPod shuffle. That's what they were giving away to come. Free iPod shuffle, or stay home and wallow in my misery. So I went. While I was there, By the second day, I met two people. I met Mike and Greg. Now, these were the guys that were speaking, and these two guys started talking about how they were buying real estate, how they were getting money, how they were using hedge funds. And everything they told me made me realize very quickly that everything I was doing was the complete opposite of what they were doing. And I had a realization that if this is the opposite of everything I've been taught my entire life as an advisor and everything else, what else don't I know? And I started questioning everything. And at that point, I dove in and I did everything that it took to seek out the knowledge that they don't teach you. And that's where the story really begins. And that brings me up to current on that journey. And now Greg is one of my partners. Mike's one of my good friends. And it really was a self-realization of the things that we learn our entire lives about how money works is not what the wealthy do with money. What the wealthy do with money and what the wealthy do with, much like what you guys do, most people are not privy to that information. You have to seek that knowledge out. And once I did that, I learned that, the biggest problem in my life wasn't money. The problem wasn't the economy. The problem was the misinformation that I've been given my whole life. And that's when I got off the financial hamster wheel and started learning everything that I know today, started applying all these secrets of the wealthy, the things that I wrote 2 books on. And that's exactly how I did it.
Wow, what an inspirational story, from starting from nothing, right? And then your mom being that hero and that guide to support you in the beginning, to hitting the wall for really a first and a second time, and then overcoming with some new guides with Mike and Greg. Before we dive into some of the tactics and some of the wisdom here to flush out on exactly what you're talking about, I'm curious though, who was Chris before the 17-year-old, snowboarder, entrepreneur by spirit? But more beyond that, what gifts were you given? Or even more so, what particular gift were you given? I think we're all given some kind of, either it's a superpower, I think it's a God-given gift that you use today, and how does that connect how you help people today? So I want to connect you with that gift with how you help people today. And that's a long-winded question, but I think you get the gist.
Yeah. So, one of the biggest things, my mom's been my unconditional one my entire life. And one of the things she taught me when I was really young is spend more time listening to people and be a good student. She said, always listen more than you talk. Take what you learn and apply that knowledge, because you don't have, we didn't have money. So all we had to do is just take what we had and make the most of it. So I became a really good listener, and that's gone through till today. I mean, it's one of the reasons, that I'm a very good coach. I'm a great money mentor, is because I'm very good at listening, but I'm also good at taking complicated things and bringing them down to a very simplified level. Because back then I wasn't smart. I was never that A student in school. I was never that Ivy League kid in college. I was like the average kid who knew just enough, but I was willing to outwork everybody else, and I was willing to outlisten everybody else. And I was a phenomenal student. When someone told me something, I took that. I took great notes and I applied that knowledge immediately. I wasn't the type that just took knowledge and just like, well, I'll get to this someday. No, I took the things that I wanted to learn and I immediately found a way to apply that knowledge. And that's been like everything that I've done my whole life. Even my coaches today, my high level coaches, they all say I'm one of the best students, but I spend more time just listening. And I'd say that would be with that thing prior to that 16-year-old kid that I had.
Now apply that to how you help people today.
So what I do today, and it's multifaceted. So I've got the Money School and the Money Multiplier, which are really two different things. The Money School is really an education platform that teaches people how money really works, but it does it more with a real estate focus and an entrepreneur focus. So if somebody's trying to find money for their real estate deals, the Money School basically we've created an entire system to teach people where all the money is for all the real estate deals they've ever wanted. And these are places where they wouldn't think to go for money. These aren't the traditional banks. Even though we teach how to use banks and how to leverage banks, that's not mostly what we talk about. We talk about private lenders, hard money lenders, and where all this money is. And the biggest sources of money, as you are well aware, is in employer-sponsored retirement plans. I mean, there's tens of trillions of dollars sitting in 401ks, 403bs, TSAs, and all those fancy, government-sponsored and government-made, in some cases, retirement plans. So those retirement vehicles are one of the places that I've gotten very good at. Now, when I was a financial advisor, and I worked for a lot of big firms, and I'm not going to get into the names of them because I try to leave that out, but some of the biggest firms that you deal and hear about every day, I was a high-level advisor, and I actually got to the point where I was managing large portfolios for them. And while I was doing that, I learned all the things that you needed to learn about investments, mutual funds, ETFs, and specifically the rules behind employer sponsored plans. And I never really liked the fact that as a young man, every dollar I put into the 401k, I gave up control of that money. But I never really understood how to take back control. So the money school shows people with basic 401ks how they can leverage their 401k, how they can use the money in their 401k through loans to fund deals or to lend money to others for their deals. Because not everybody wants to swing hammers and flip houses. And I don't blame them. But some people just want to make more money on their money. And when the markets start falling apart, a lot of people want to know what other options they have. So we teach a lot of that. But then the second thing that we teach is a lot about self-directed IRAs. So how to use traditional IRAs, Roth IRAs, and how to actually self-direct them and use them for things like real estate, things like what Mitt Romney would, private investments, private funds and stuff like that. So we teach all that. But the other thing that we really do at the Money School is we teach people how to basically solve people's problems. If you need money in any capacity for your business or anything you're doing, the last thing you should ever do is ask for money. You know how I learned that? I've asked enough times to learn that every single time I ask, I usually hear the answer no. So I stopped asking and I started learning that if I need money, what I have to do is solve people's problems. People all have the exact same problem. It's a beautiful thing that this is a uniform thing. That problem is they all want to make more money. Right? Isn't that the problem you come across a lot? People just want to make more money or keep more of the money they make. That's it. So what I found is a system and a way to show people how to solve that problem for people. First, show them how their vehicles work, show them what they can do with their vehicles, and then present them an opportunity that solves that problem. And that opportunity, when you present it, you're never asking for money. You're just talking about the pros of your deal, the things about your opportunity. And then at that point, that person's going to want to engage with you because you didn't ask them for something. You're sharing something with them. And then we just basically created the entire system of how to take that opportunity and structure it so that that opportunity could be shown to a bank, to a private money lender, to an institutional lender, to anybody basically under the sun that's got money that would want to see this opportunity. How do you present that to get results? So that's Money School. But then I went one step further. See, I'm a big private lender. I lend a lot of money. And the biggest problem I hate as being a private lender is I hate when people bring me deals that are incomplete. It takes time. It takes energy, and it takes teaching people how to then go back and get the deal and make it the right way so that I want to look at it and I got all the pieces that I need. So I literally created the standard operating procedure on how every deal should be put together. And this works for banks and everyone else. But then I said, how cool would it be to have a community, almost like eHarmony? You know what eHarmony is, the dating site where they kind of match up people. Well, what if I created a community where I had borrowers and I had lenders? In the middle, I had education, and I taught them exactly how to be a good borrower or a good lender. But then outside of that education, I created a standard operating procedure. And then the lenders and borrowers just have profiles like they would in any other account. And then the borrower can submit their deal to the lenders that match up with their profile of the deal. So I just created the eHarmony for lenders and borrowers, the community. And that's just kind of blossomed. I did it self-serving because I wanted better borrowers. I didn't want to have to spend time teaching them how to bring me a deal. So I just standardized everything. And I created systems and processes to do that. And how I figured all this out back to when I was a kid is I learned how to listen. I learned how to listen to what people wanted, what they were struggling with, what things they didn't like and what things they didn't want. And I literally just kept solving those problems. Some of it was self-serving. Some of it was because I wanted to give back and help other people learn how to do this. And that's what the Money School is. The Money Multiplier is literally probably one of the craziest things that I can even explain. I don't know how you really want to tackle that one, but it's the single thing that changed my life more than anything else I've ever learned. But is that one thing in 2014 when I learned about it that I literally saw it. It was brought to me by that guy, Mike, and he showed it to me out in Salt Lake City. And I said, Mike, this is too good to be true. There's no way. I'm an advisor. I know all this stuff. There's no way this is possible to do this. And that's really the biggest thing I do today. I travel the country speaking on stages. Usually I'm in 3 different cities every week speaking about this topic, the money multiplier, and teaching people how to basically take back the banking functions in their life and become their own bank by changing one thing. And I teach people how to build wealth through their own debts and expenses that they already have. And then I just show them how to change this one thing. And that one thing then changes everything else in their life. And that this whole system is beautiful because it's the system that the wealthiest Americans have used for hundreds of years. It's created by the Rockefellers, the JPs, the Morgans, the Rothschilds use it. Every bank under the sun uses it. Every Fortune 100 and 500 company uses this banking system, yet not many people know what it is. And even the ones that think they know, they have a little trouble understanding its true potential.
Yeah, and so before we dive into exactly what that is, we've here at Capital Gains Tax Solutions are all about exactly what you're talking about, creating more wealth, preserving more wealth, keeping more wealth, saving more wealth, right? And as a part of that, it's learning about these systems and about these strategies and these proven tactics that people have used for a long time. So what's been the single biggest challenge you've seen when it comes to capital gains tax deferral and or traditional tax savings, right? Either for yourself or for your partners, or maybe one of the biggest mistakes you see, wealthy, educated people make every single day. Can you walk us through that and then connect it to what the strategy you were just referring to?
Sure. Let's go back to just the most common place people put money, the largest source of money, which is employer-sponsored plans. From a young age, and I know even my grandmother told me this, we're taught to save money for retirement because if you look at statistics of Social Security, they say that out of 100 people, only 5 of those 100 are going to be financially secure at the age of retirement. So the easiest way that we know how to save, as soon as we get into the workforce and the career force, we're shown 401ks, employer-sponsored plans. So it's so easy. Some of them, you don't even need to sign a paper. You just get employed and automatically you're enrolled. And we basically put money in these employer-sponsored plans. But the biggest struggle that I've had and the biggest mistake I think a lot of people make is if you really boil down and think about what you're doing when you're funding a 401k, number one, you're saving for retirement. That's a good thing. Okay. But number two, aren't you giving up good dollars today? You're giving up control of your money that you could use for opportunities today. And the other thing I always tell people is I say, you know what, your dollars are worth the most today, because if an opportunity comes across your desk, you need to have money to take advantage of that opportunity. Well, most people that I see, even wealthy people, put a lot of money, sometimes most all their savings outside of their primary residence is going into these employer-sponsored plans. And they're putting the money in there. And while they're doing that, they're giving up control of their money. And really what they're also doing is they're giving up control. They're giving up control of their good dollars today to be paid back with weaker dollars later. Because do taxes go up or do taxes go down? I think we could all agree taxes usually go up. Even if they don't go up, don't they just find more crap to tax us on? Look at Florida. I love this example. People flock to Florida because there's no state income tax. But when you drive down the roads, the throughways in Florida, how many toll booths do you hit? I swear to God, it's one every quarter mile. Tolls are taxes. They just find more crap to tax us on. So back to the taxes. If taxes go up, then we're putting money into these employer-sponsored plans and we're deferring this money to an age of 59 and a half. And for someone that's young, that's a long time. And you really have very limited access and limited control of this money. The financial companies are in control of the money, not you. They just give you a basket of investments that you can invest in, and then you pick those investments. And most people don't even know much about what they're investing in. They know whether they made money when they got their statement or they lost money, or they know whether they're in conservative, moderate, or high risk. And a lot of people don't have advisors. They just rely on the advisor that's on the employer-sponsored plans. They don't have people like you guys that really are watching out for their best interest. So they're putting this money here. That money's growing and growing or not growing like the last week, in the market, but eventually they have more money. And over this long period of time, what has also happened? Haven't you really just compounded the tax on your money? Because if you're in a traditional 401k, when you take that money out at 59 and a half, or when you decide to take it, you're taking that money out at your current tax bracket. And your current tax bracket is probably going to be higher because you're making more money. taxes probably went over that period of time. But even if they didn't, you're still taking it out on a larger sum of money. So the government figured this all out. We're going to give you the ability to basically put money into this, and we're going to give you the benefit today, but then we're going to hit you on the larger amount in the future. They're not dumb. They know exactly what they're doing. And the biggest mistake people make is they get led down this path of giving up control and then being paid back with weaker dollars later. I always tell people, we do things with money we would just never, ever do with things that money buys. Think about it. Would you ever buy a loaf of bread, come home, put that loaf of bread in your freezer, close the door, and wait 5, 10, or 15 years, come back, take that loaf of bread out and eat it and enjoy it? I mean, come on, you'd be freezer burned. You wouldn't eat that. Same thing. Would you buy a car and wait 5, 10, 15 years to drive the car? Would you buy your primary residence and wait 5, 10, or 15 years to live in your house? If you did that and you're married, you wouldn't be anymore. But see, we do things with money we would never do with things that money buys. When we put money in these plans, we never really realize that we gave up control, where we're losing opportunities if that's our only money. But then later, the biggest mistake I see, as an advisor, I saw this all the time. People get to that age where they can take that money, 59 and a half, and they don't, because they don't want to pay tax on it. And then that money sits there, and then the government makes them take it out at 70 and a half for RMDs. And then when that happens, they still complain about taking it because, oh my God, I don't want to take this and pay tax on it. Why do we give up control of our money to just later not want to take it because you got to pay tax? And then you hear, oh, it's a legacy thing. I'm just going to leave that money for my family or my beneficiaries. Great. Well, that was good up until the new Secure Act, right? Now, the whole stretch IRA thing, and you guys are well aware of this. We used to be able to, somebody would pass away, or as I like to call it, graduate, and they had money in IRAs or employer-sponsored plans. They could basically roll that money over into a stretch IRA or an inherited IRA and kind of defer those taxes for a long period of time. Not anymore. Now you have 10 years to take all that money out. How much money does that make the government in taxes? I don't know, but it's a lot. So that's the biggest pitfall I think I see, is that people give up control of money, chasing a future goal of retirement, which someday isn't what they wanted. And then they're scared to take the money because they don't want to pay tax on it.
So there's a better way, right? And that's part of why we're on this show, is to help people, create and preserve more wealth through investment in real estate and other financial instruments. Don't get us wrong. There's a place for each tool, but I think what I'm hearing you, Chris, is so many folks are just really kind of passive, give up the control, follow the habits of 401k investing, and they lose out on opportunity costs, right? It's like trading time for dollars. In this sense, it's like you're putting in the 401k, which is locking up time for all of the opportunity you could be making with those funds. Oh, by the way, you could be putting them into real estate deals, which you can use depreciation and accelerated depreciation to offset all of that income, and then start to compound your money even more so, and or do hands-on value add real estate deals where you're putting sweat equity and you're making your money and yourself work for you to build that wealth. And by the way, if you don't want to do it yourself, there's groups that syndicate deals, operate deals. That's what I personally do. Senior housing, absolutely. Mobile home parks, multifamily, mixed use. And so there's so much more ways to create and preserve more wealth beyond just the traditional means. So that's step one. So what's step two after that, Chris?
So step two is what we tell people is, and I'm not knocking 401ks. Don't take, they're good vehicles for some people. And if you got a match, by all means, you should be putting in up to that match and capturing that match. But really what you should be focused on is diversifying. And a lot of people, when I say that word diversifying, they think, oh, I'm diversified. I've got this stock and this bond and this mutual fund and this ETF. No. I mean, diversify your cash flow, diversify your asset classes. So in other words, you got some money in employer-sponsored retirement plans. Maybe then take some money and put it into real estate. But then you say, oh, I don't want to own real estate. I don't want to get calls on Sundays. Great. Do syndication deals, do private funds, be involved in real estate, because real estate is single-handedly, in my opinion, one of the greatest investments of all time. You can do so much with it. You can force appreciation, you can leverage it. It can never go to zero. Okay. And if you think it can, then you forgot that you have to put insurance on the properties. And then also the best thing is tax advantages. There are massive tax advantages. Why do you think the wealthy put money in real estate? Number one, it's a great investment, but number two, they understand so much, just like you guys. I mean, when I had you on my podcast, the things you said, I'd never heard of them. Much like what I'm going to talk about in a second, I'd never heard about what I'm going to explain, this banking system, until 2014. And when I heard about it, I'm like, no way. Why wasn't I ever shown this? How come nobody ever taught me this? Well, that's the reason why people just go to the traditional, conventional financial places that their advisors tell them. But they never really realize that there's other alternatives, because there's nobody out there really talking about these other things, because it's very difficult to make money on people when you're just giving good advice and telling people what the wealthy do. So what I always tell people to do is I say, okay, so if you believe even a little bit about what I just said about not wanting to give up control, and then taking back some of that control by changing one thing. Well, what is one of the greatest things where people like to put money? Well, people like to put money in a place where they have complete access to it. That's number one. They don't want to work any harder or any longer. It's okay. They want to just kind of continue doing what they're doing. So it'd be nice if you could build wealth by doing nothing other than building wealth through your own debts and expenses you have. If we could just take back the interest that we're paying to everybody else and had a method to do that, then you could build wealth just by taking the money back you're giving away every day. So that's one thing. But then the other thing too that people love is what they don't love is risk. So this thing that I'm going to talk to you about, which is so freaking simple, is guaranteed. And what the wealthy have figured out many hundreds of years ago is they found that the best place to put money is not conventional banks. Banks hold way too much risk. If you ever read the book, and I'm going to probably butcher the name, but The Creature from Jekyll Island or Jackal Island, that book will teach you why you should not have too much money at banks. It'll scare the living tar out of you if you read that book. I'm almost finished with it. It's like 600 pages. So the wealthy know that banks are kind of a place where you got to have some money, but not all your money. So what they did is they found that the safest place to put their money, if it's not banks, and they want it to feel and look and have liquidity like a bank is, they found insurance companies were the safest place, because insurance companies don't practice fractional lending. Insurance companies are boring. They're old school. They especially mutually owned insurance companies, they do things by the old rules, the Austrian economics, if you will. So what the wealthy figured out and what the banks figured out is, well, what if we can create banking systems using insurance companies? And what we're really after is we want those returns of those insurance companies' general account. Because an insurance company, really, if you think about it, they have all the money. They have all the money, and they constantly have new money coming in because people are always paying their premiums. So the insurance companies constantly got new, fresh capital to take advantage of opportunities. So the returns in an insurance company's general account are that which can't even be matched by just about anybody. They're so steady, so solid, because insurance companies invest for hundreds of years, not for 10 years, not for 5 years. They look hundreds of years in the future. And therefore, because they do that, they can capitalize on things no one else can. So then the next question comes, well, okay, that sounds great, Chris, but how do I create a bank? How do I create a banking system with insurance companies? Now, this is the part where I usually lose people, because people constantly think they know what they don't know. And you know who was that person? This guy right here. In 2014, when I was told this, the first thing I said to him is I said, well, I'm not going to swear, but I said, Bull, you know what? And then I said, that sounds too good to be true, so it must be. Well, what they do is they basically use one of the oldest financial vehicles called whole life insurance, dividend paying whole life insurance from a mutually owned company. But they don't use whole life insurance like whole life, which is for life insurance, right? Because that's what you know. You go to your life insurance store, you buy a whole life policy. It's Dave Ramsey would say that that's a bad idea because it's a bad investment. Indeed, it is a bad investment. So don't invest in whole life. I hate to say it that way, but what whole life provides you is access, if structured properly, which is structured to almost the complete opposite way you'd build a life insurance policy, structured to give you access to the insurance company's general account. And then if we had the ability to put money into the insurance company's general account, that would give us the ability to make a guaranteed 4% return. Now, I don't know any banks out there paying a guaranteed 4%, but you know who does? Insurance companies. So now we got a guaranteed 4%. But then what we did is we got smarter and we found mutually owned insurance companies which treat us like stockholders of large corporations. Now, because we are at a mutually owned company and we're an owner, quote unquote, a policy owner, we now receive an annual dividend. So now not only are we making 4%, now the insurance company is being so gracious, they're giving us a dividend every year. So now we got this dividend and this guaranteed 4%, but now the story really takes a twist. What if I told you that insurance companies built properly, the whole life policies built properly so that they work like banking policies? You can put your money in the insurance company and you can immediately, in the next 30 days, as soon as your check clears, you can take your money back out and use that money for whatever. Now, how much can you take out? That depends. It's never going to be less than 60% of what you've deposited, but more commonly closer to 70, and we can get up to 90% access to your money immediately in the first year. So now we put our money in, we're making 4%. Now, if you put your money in the bank and your bank was gracious enough to pay you 4%, but then the next day or the next 30 days later, you went back to your bank and you took your money out, doesn't your interest stop? It does. So it defeats the whole purpose of earning compound interest, because compound interest works when you put your money somewhere and you leave it sit. And by the way, there's not a business in the world that uses compound interest. Banks don't use it. They just charge us compound interest and they pay us compound interest. Banks move money, which doesn't mean they use compound interest. Grocery stores move inventory, which is groceries. Car dealerships move cars. There's not a business in the world that uses compound interest. But what if you had a way to make uninterrupted compound interest? You know, the stuff that Albert Einstein talked about, the ninth wonder of the world, the most powerful thing in the financial universe, which is called uninterrupted compound interest. The ability to put your money somewhere, earn 4% plus dividends, be able to take that money back out, but yet still keep earning interest on the money, even though you took it out. Wouldn't that be exciting? Well, that's exactly how it works. You see, when you deposit money through your whole life into the insurance company's general account, you can take loans from the insurance company. Your money in the insurance policy acts as collateral and continues to earn uninterrupted compound interest, while the insurance company graciously and gladly loans you money at a lower interest rate than what you're earning, and then you can take and use that money. But the funny thing is if we think of banks, when we take loans, don't we have to pay loans back? Absolutely. And if you don't pay a loan back to a bank, what do? Well, they take whatever you used that's for collateral, or they hit your credit. Bad things happen. But when you take loans from an insurance company through your whole life policy, specially designed whole life, I got to keep saying that because people constantly want to think of that fancy life insurance thing. This is built totally different. When you take a loan, the insurance company will never ask you for that money back, ever. They don't care if you ever pay it back. Just keep paying them their interest on it, okay, which you're already making more than what you're paying them because you're earning uninterrupted compound interest and you're paying them simple interest. The reason they don't care if you ever pay that loan back is because didn't the insurance company promise you a death benefit to be paid upon your graduation date or your death? They did. Now, we're not doing this for a death benefit, but there is one there. So when we take these loans, if we never pay them back, we're really just taking an advance against that death benefit because whatever loans we don't pay back, the death benefit drops. What you now have, if you just take even just a smidgen of what I just told you, is you now have the almost perfect banking system. You have a place where you can put money, earn interest on that money unconditionally and uninterrupted, take your money over and over again, never really have to pay it back if you don't want. And someday when you graduate, there's going to be money there that's paid to your beneficiaries to provide that legacy. Well, do you think that you've ever thought about the wealthiest families, the Rothschilds, the Rockefellers, as to why they never, ever can run out of money? Well, do you think they use that system? You're darn right they do. And every single time one of them graduates, a big death benefit is paid back to that family trust or the plans like what you guys create, and that money is used for the next generation and the next. So I know I went long in that. I'm sorry. I get really excited and passionate because when I learned this, that one thing single-handedly changed my entire life, because that system I just told you is exactly how I paid down over $100,000 in debt. It's exactly how I scaled my real estate business by having money that I was using from the insurance policy to fund my real estate. And today, that is how I lend money.
Excellent. So let's walk through a couple questions that come to mind. The first one would be, what percentage of someone's wealth, let's say someone's worth $1 million, and let's say that's, let's imagine they're debt free and they got $1 million in wealth. What percentage would be allocated, would you suggest, in say investment real estate, this whole life policy, stocks, bonds, mutual funds? What would be, kind of as a financial advising background, what would be the allocation there at any given time?
So that would be the traditional way that I used to think, but that's not really how we do it. So usually when we're meeting with people, they've kind of already got things set up, right? So they've got certain things, and we're not going to advise them on have this much going here, have this much going here. We might kind of help them reallocate and change where some of their monies go. But with the banking system, what we always tell people is we start with what you're already doing. So they have no debt, but they're saving money somewhere. So where is their money going? And we identify where all their monies are going. And what we say is, well, how about we just take the monies that are going into something similar to a bank account? Let's take some of the money that you're putting into these safe investments over here, maybe fixed annuities or money market accounts or treasury bonds, right? Let's just take that money and let's reallocate those assets over to this asset class, this specially designed whole life. Because really what we're trying to do is just mimic what you already have with a bank account, but do it better. So that's usually how we would do that. So when you look at what percentage is going to go here, there, or anywhere, I mean, it's very specific to the individual. I always tell people, I say, well, the first thing I would tell you not to have much money in is qualified plans because you lose control. But most people it's already too late. They have too much money there already. So we'll say, how much of that do we want to keep there and how much do we want to self-direct? So we'll kind of help them organize that a little bit. And then, like I said, with this banking system, I usually take monies that mimic what we're putting the money into. So I try not to take monies from brokerage accounts because if people are putting money in brokerage accounts, as long as they've got good advice, which most people don't, because, I've been telling people to be careful of what's coming in the markets because we're at a high point for a while. And do you think people listen? No, they just keep rolling and they just, then they complain that the market went down a couple thousand points and they wonder, well, why didn't I do something? Because you don't listen. You should have done something, but you should have done something before it went down. And most people, when did they take money out of the market? When it's already down a lot. And then it's too late. But that's just the general nature because that's fear. That's just reality of what happens. So I know I'm dancing around it, but I'm really not. There's really not a specific answer. We don't work in the general capacity of the way I worked as an advisor. We actually keep it very casual. So I work with lots and lots of multimillionaires in this, and I have a very candid conversation. I say, they show me all their assets, and I say, what's working and what's not. They always have a problem. Well, I'm really sick of this. I don't like the way this one works. This has high fees, and we identify those. And I say, okay, well, here's one option. Here's another option. So whatever their percentage is in that asset that they're having issues with, we reallocate that. So, and I know kind of where you're at because as an advisor, as a financial planner, when I was doing that, that's how we always did it. We always had, a graph and we always basically, had pie charts and this was your asset mix, your portfolio mix. We don't really do it that way anymore, at least for what we do.
Yeah, no, that's thank you for that answer. That's good to know. And how about the LTV?
Mm-hmm.
So if you're borrowing 60 to 90% of the total value, let's imagine you had $1 million in there. You mentioned you're borrowing against the plan, of which if you die, then it'll pay back whatever you borrowed, so you can take that loan for as long as you want. What's the interest rate generally? What's the spread there between the 4% that it's compounding and what you're borrowing at?
That's a great question. So typically most insurance companies we work with charge 5% simple interest. So you're making a guaranteed 4% plus the dividend. So the dividend plus the guaranteed 4% is usually about 5.5%. It was a little higher, but most of the companies just dropped their dividends. So if you're making 5.5 and this is your first year only. So first year is the worst year. You're making 5.5, you're paying 5. So you're making 0.5%. So you're making 0.5% while still having access to your money. But then you don't have access to all of your money in the first year. So if somebody had $1 million, I will tell you right now, they would get access to roughly 93% of every dollar they put through the banking system. I just did one the other day, and that person got 93%. So the other thing too that's really important to understand is that's the first year. Now remember, your money, that $1 million, is compounding at 4% plus the dividend. So let's call it 5.5%. So the next year you've got a higher balance. Okay, so if you've got a loan over here, the loan is still on the same amount if you never paid that loan back, which we would always tell people, we want to take money out of this plan and reallocate that money to something that we can recycle and recapture. For example, cars. What if I could show you that this method would be the best method where you could get all the money back for every single car you're ever going to buy, drive, and own? Now, I don't care if you're, middle America or you're the wealthiest person. We all have cars. So wealthy people still like getting all the money back for their cars. With that method that I just said, because of the uninterrupted compound interest, you could take a loan from your banking policy. That $1 million you put in, you take whatever amount you want from that, you go out and you buy a car. You pay cash for it with your banking policy. But then instead of just saying, okay, I did that, now I'm done, because that would be a bad way to do it, what you do is you figure out what that car payment would have been if you financed it through the dealership's finance company. You take exactly that dollar amount and you recapture that money back in your banking policy to pay that loan down. Now, you didn't change anything, right? Because you would have more than likely either just paid cash for the car and lost the earning potential on that money, because that's what most people do that pay cash. They exchange money for the car, and that car is a depreciating asset. But the money they paid for the car, they lost all earning potential on that money because they took it from a brokerage account, they took it from a bank account. One of those two things were paying some interest. Well, when you take the money out, you lost all the interest. This system, you didn't. So by doing that and using that money, you're still making interest, but now you get to recapture the monies that you would have paid in financing anyway. So that's how you get all the money back for every car that you're going to buy, drive, and own. But ultra wealthy, when they're really looking at this system, why are they going to do this system? Like, what would be the biggest advantageous thing for somebody that's really wealthy? Well, let me talk to you a little bit about the family offices that we work with, because they manage tens of millions and hundreds of millions of dollars. And when they do this system, because many of them do it, they call it privatized banking. They don't call it the money multiplier. They call it privatized banking. They're doing it because they want full liquidity of their money. They want their money to earn the highest interest rate on a guaranteed basis. But then when they have the opportunity to take that money out and buy into a business opportunity, or take that money out and buy Apple when it's down 30%, they immediately can take that money out and redeploy that money and buy these asset classes. But the other thing they do this for is tax reasons. So every dollar that goes into these banking systems, although it goes in after tax, much like a Roth, every dollar that grows inside that banking system is potentially tax-free, because all that interest and all that money, the dividends they're paying you, as long as you keep reinvesting it back in the policy, that money just keeps growing and growing. But yeah, you can still access that money and not have to pay tax. Because if you go to a bank and you take out a home equity line of credit on your house, and you pull your equity out, let's say you took $100,000 out of your house, you don't have to pay tax on that, right? Because it's a loan. You essentially have to pay that money back to the bank. Over here, I already told you, you don't have to pay it back, but you can. Because it's a loan, you don't have to pay tax on it. You could literally take that money out, enjoy it tax-free, and never pay it back. And then the insurance company will make up for it when they pay your death benefit. So the wealthy use this system because of the guaranteed interest, the liquidity, and the tax advantages within the insurance policy. That's the number one thing.
Got it. And when you're mentioning taking it out, you're referring to just taking a loan secured against the policy, right?
Always.
So 69, you're not actually taking out the amount in the policy, and then when you take it out, you can go for as long as you want.
Just like stocks.
Go ahead.
Sorry. I was just going to say, we got a delay a little bit. I just noticed that. But just like stocks, you can take withdrawals up to the basis without any taxes.
Got it. So withdrawals up to the base without any taxes. And then you can access it quickly, liquidity, maybe 2 or 3 days, whatever it takes to get that money in there. And then you don't have to ever pay it back. When they get it back is when you graduate, when you die, then the death benefit will pay it all back. And any additional interest, I guess, would be passed on to your heirs.
Correct. But when we're doing the banking systems, what we're actually doing is we're instead of building or buying a life plan, what we're doing is we're putting the lowest death benefit, and we're supporting some of that death benefit with term insurance because it's cheap. So how it actually works is when we first set these banking policies up, the death benefit's usually pretty low. But every deposit this person makes into this banking policy, okay, every time they make a deposit, their death benefit goes up. So over time, they make deposits, the death benefit just keeps going up and up and up and up. So even when they're taking these loans, they're taking the loans off of an already increased death benefit. So it's what we normally will see is over time, if somebody keeps using that money, even though when they pass, when they graduate, that money's paid out, the death benefit is still very substantial because every single deposit increases the death benefit. It almost has to, because you can never have more cash value than you do death benefit. So the insurance companies have to kind of ratchet it up as it goes. And that's how it works. And so you're always going to have a nice death benefit, even if you just intentionally kept trying to take as much money out as you could and never pay it back.
Fascinating, Chris. Yeah, my brain is working here, right? And so it's really fascinating. So, any last thoughts on that before we shift to a last few questions and wrap up the show here?
No,
Yep.
I think that's just like a really good kind of high level look at it. And then from there, there's IRS rules that go in with it called the Max 7 pay rule. So there's lots of restrictions. Pre 1988, very wealthy billionaires were putting billions of dollars into these plans and just using them as tax shelters. But the IRS stopped that in 1988. So now there are limits to how you can put money in. So if you had somebody that had $1 million and they're like, I want to just dump $1 million in, probably going to be tough unless they're going to put 500,000 in each year thereafter, because we got to play with those IRS rules. So although that sounds great, you can't just get crazy and just start dumping large chunks of money in there without getting the IRS rules into it. That's
Right.
the only
So,
other thing I wanted to say
so
about
this would be this is the time where you reach out to Chris and you get a customized wealth plan for these types of this type of vehicle, privatize banking, and see what would fit for your scenario. So Chris, you're obviously a wealth advisor and you also own some real estate. So talk to us a little bit about owning real estate and your strategies there for building wealth.
Sure. I mean, real estate's always been my go-to. Since 2006, I started flipping houses and I just never stopped. So all the way through this to date, we've flipped 257 houses. We had a rental portfolio of 91 units. Last year would have been our peak, but then what we've been doing now with the market being as high as it is and our retail values being high, we're packaging together our rentals and then we're selling them off as portfolios. Because everybody, a lot of like people know the 1031s. I wish more people knew what you did, but they got all this money from the sale of a big property and they're looking to reallocate this money quickly. So I'm kind of taking advantage of that. I hate to say it, but packaging these rental portfolios off and selling them off at literally full retail price. So we've been doing that. So we're down to 55 units now. But with real estate, how I really do my real estate business now is really a 4-step process. Step number 1, every deal that we find that we put under contract, I'll try to wholesale that deal. I'll try to sell the contract to, some investor that's looking for that deal, because I really don't want to swing hammers. I don't want to flip houses. I can't stand it. So I'll try to get rid of the deal and make the quick dollar. And it might be less than what I'd make if I flip it, but it's still quick and easy. If I can't wholesale it, I try to look at, can I make money flipping it? We just put a deal under contract yesterday, and my wife, I just can't get her off this flip train. She's like, I can flip this. This will be a great project. And it is. The numbers are all there. So she wants to flip it. And the numbers say that we will make 20%, or actually we'll make more than that. So if our strategy is, if we will make 20% on the deal, we will keep it and we will flip it, which this one qualifies. But let's just say it was 10% that we were going to make. I will then move that strategy to strategy number 3, which would be to BRRRR it. So BRRRR is a fancy way of saying rentals. But doing a BRRRR is basically we buy it, we rehab it, then we rent it, and then we take the deal. So all this is done with private money, self-directed IRAs, private lenders. We take that private money and we refinance it through a community bank, because community banks love fully renovated, rented properties right now, and they'll just dish money out like candy for those things. So we refi it at the bank. We get all the money back. We pay the private investors. And now what we hopefully have is a property that if we did it right, we have no money, none of our own money in this deal. None. It's all the bank's money. So we've now leveraged the deal to 80 cents on the dollar. We have not one penny of our money. We literally have created an infinite return, cash on cash return for our money, because we don't have any money in it. And I have literally perfected this system. I've even trademarked that name BRRRR, which is BRRRR, because I love it so much. And if we can buy them the right price and do it right, that'll happen over and over. So how fast could you scale a rental portfolio if you didn't have one penny of your own money? So that then led me to the next thing in real estate. If I wasn't using any of my own money and we're still flipping, we were building up money over here. So then that money's going to the banking policies. Then I got to move that money in the banking policy. If I don't have any debt to pay down, if I don't want to buy any more flips, then that money's got to do something, because that's the only way money really makes money, is when you keep it in motion. So what I've become is a private lender. I started lending money out to other real estate investors that I have taught and trained through the money school, taught them how to be a good borrower. So I lend money to them through my own community, my little eHarmony community that I've created. And that's what I do with real estate. And I'll tell you what, I only wish I knew what I know now back in 2009, when I had to sell all 36 of those properties in 14, because if I had those properties today, woo-wee, it would have been like buying Yahoo back in its heyday and just riding it right to the top. But unfortunately, I had some learning to do, and now I'm doing it the right way. But I'm waiting for the next downturn.
Yeah, now you can help more people do it. And I love the BRRR. So buy, renovate, rent, and then refinance, and then essentially hold on to that asset. Now it's cash flowing asset, and then go use that extra money to go leverage another one and do the same thing over and over again and help people along the way. Now through your community. Now, curious. So there's 55 house, well, the 270 or so, and now you have 55. I couldn't help but ask, but how are you going to defer those capital gains taxes, or what are you doing there to mitigate some of those taxes and those gains?
Oh my goodness. If I had only known you when I sold that strip mall, I wouldn't have had to pay taxes on about 169,000 on that. But then just last year I sold a $1.6 million rental portfolio, and I didn't know you then. That would have been a great plan. I looked at 1031 exchanges, but I'm just like, you know what? I don't want to buy anything at these prices. So I literally just I took the lickings. I mean, I had a lot of deferred losses carried over from the flips. The beautiful thing about flipping is you can really control your taxable. There's so much you can do, and I'm not going to get into that. You guys know all about it. With flipping, I can roll deals into the next year. I can play all sorts of fun things, so that I don't have to pay much in taxes. So I had the year I sold that 1.6, I had a whole bunch of deferred losses that I carried over. So that kind of helped me a lot in 2019's taxes. But you know what's going to happen this year? I'm screwed if I sell any more of those. But the good news is I met you guys. So now if I sell any more of these portfolios, which I will, I just got to package them up and sell them. You will be the person that I'm going to be doing that system through, because I don't want to pay taxes on that.
Yeah,
I
and just
really
to
don't.
clarify for people who are listening to this for the first time, or maybe just catching on this, so the 1031 exchange, it's a short 45 days to identify, 180 days to close, equal or greater value. Not easy to do, especially in a highly appreciated market. One of the reasons Chris is selling now because the prices are so high, but by definition, that doesn't necessarily mean he's going to be able to find something low, right? Actually, it's even harder right now. So we say don't do a 1031 where you sell high and buy higher 180 days later. Sell high, move into the deferred sales trust, all tax deferred, and then buy at optimal timing when and if it makes sense for you. Or Chris may say, you know what? I'm a private lender. I actually want to lend all of that money, right? Great. Or I actually want to, diversify within multiple commercial real estate streams with different operators, myself and a couple others, different product types, different geographical locations. And when he's done that, he's taking risk off the table, which is one of the number one best ways to create and preserve more wealth, especially when things are so high, rather than just staying in a single box, in a single 1031, in a single marketplace, in a single product type. By definition, you're not diversified, right? So that is key. So any other thoughts on the 1031 exchange, and just, maybe any tough stories you've seen people go through with that?
I hate 1031. Yeah, I've seen more people just literally just put themselves through financial suicide through 1031 exchanges and force themselves to way overpay for properties that they should have. I lost the deal on this big apartment building downtown Buffalo to a guy that had 1031 money. He overpaid by $65,000 on this property, which doesn't seem like a lot on a building, but in Buffalo, that's quite a bit. I laughed at this guy. And then when I found out he did it because it was either pay taxes, which was several $100,000, or put this money into this deal. And the deal doesn't look like he did anything to it. I drove by it the other day and it looks worse than it did last year. So I think people just rush to make bad decisions because they're under the gun. With the deferred trust, the way I look at it, and I love that you said that, if I sell anymore, I'm going to put it in there. I'm not looking for more deals right now. The market is too high. And you know what? All I got to do is just wait. Just wait for the market to correct, because the stock market's going first. We're already seeing the signs of the ugly monster showing his teeth. And after that, then real estate values will start kind of coming down. And guess who's going to be ready to just pounce? Like Warren Buffett, right? Guy sitting on $128 billion ready to buy. That's going to be me. And while I'm waiting, I got to keep that money moving. So I'll just keep lending money. And if I did that through a deferred trust, or heck, even just lend the money back to myself at an interest rate. There's so many things you can do with what you showed me. I'm literally just like in awe.
As a kid in a candy shop. Yeah, that's how I was the first time I learned about it too. So, Chris, we're going to finish with a quick lightning round, just one answer, one word answers, and then we're going to move to the last question and we'll be done. Are you ready?
Great.
I'm ready. Maybe the best book you've read in the last 6 months.
The Creature from Jekyll Island.
The best podcast you've listened to recently.
The real estate disruptors.
Excellent. Let's see. Best real estate tool that you found recently that you use in your everyday business, like a system or a tool or something that helps create better communication or
Sure.
better outcomes.
It's called the max offer formula. It allows you to come up with the max offer on any property in 30 seconds.
Excellent. Best leadership quote that helps you stay inspired.
The problem in America is not what people don't know. It's what people think they know that just ain't so. That's just Will Rogers. So not much of a business guy.
But that's still applicable. Thank you. That wraps up the lightning round. Here's the last question. It's my favorite question, and it goes like this. How do you stay centered in your values, Chris? And not just centered in your values, but how do you stay encouraged to reach to new heights and new goals after accomplishing everything you've accomplished and giving back so much and driving hard entrepreneur? How do you stay centered in your values? And then how do you stay encouraged to reach to new goals or new heights?
Wow, that's a great question. And it starts with me with every morning. When I wake up, the very first thing I do, I kind of fall out of my bed and I get down on one knee and I thank God for that day. It's the very first thing I do. And then my days are very regimented. But the other thing that keeps me centered and focused is I'm always focused on helping others. The whole thing to me, so when you get to a certain point, money isn't your main objective, right? Things and money and cars, those are just like, those used to be important. But today, what's important is what can I give? What can I give that I have that will help people? Not just a couple. I mean, it'd be fine if it was a couple, but what can I do that will really change people's lives? That is what gets me up. That is what drives me every day. That's why I'm always here earlier and earlier and staying later and later. And that's why I do what I do, because I truly feel I have the gift to really go out there and change people's mindset, but change people's lives. Because I can tell you, people are trapped. They are literally in financial slavery because that's the system. That's what it's designed to do. And I show people the way to get out of financial slavery, the way to literally take back control of their financial lives. That keeps me going every day more than I can ever put words to.
I love that. And thank you so much for sharing and thank you for your time. And can you remind our listeners where they can find you one last time and how they can connect with you?
Yeah, so the best way to find me is chrisnaugle.com. And the best way to connect with me is social media. So Chris Naugle on Facebook, Chris_Naugle on Instagram. I still respond to every single message on each one of those, which is a daunting task, but that's your best way to get a hold of me.
Great. And that'll all be in the show notes for everybody. And so, Chris, thank you so much from all of us here at Capital Gains Tax Solutions for being on the podcast, sharing your wisdom, sharing your inspiration, sharing your story, being open and honest, and using the gifts you've been given to help people now create and preserve more wealth and live a bolder, a brighter life and for the future. So thank you so much for what you do and keep it up. And I want to thank everyone else for listening to the show. Again, Capital Gains Tax Solutions podcast, where we believe not having a clear plan for capital gains tax deferral is the enemy, and using systems such as the one that Chris mentioned in real estate and, of course, 1031 exchanges, deferred sales trust, finding out what best fits you is the best way for you to create and preserve more wealth. I'm your host, Brett Swarts, and I hope you can share this with somebody if you found it inspirational, if you found the information actionable. Go ahead and take action, share it with somebody, and until next time, thank you so much again for watching the show. Wow, what a content-filled, lots of meat on that bone to chew on from Chris. Definitely have to go back, I know I do, and re-listen to that episode and really kind of absorb and pause and hear what he's saying there. A couple things really stick out. The diversified cash flow streams. I think that's so important, right? Diversification is not just putting it into different vehicles, although that's a part of it. It's even more so, how do you diversify cash flow streams? So that could be different product types. That could be another business. That could be a dividend paying stock. That could be, of course, investment real estate. It could be a syndication operation deal that you're doing with someone else, and then one you're doing on your own. Maybe it's a fix and flip deal. That is a great way to create and preserve more wealth, is by diversifying cash flow streams. Also, he touched on giving up control, right? So if there's ways where you can keep your access liquidity to your funds and not have to give up control, that is a great way, I think the best way to make sure you take advantage of opportunities when they come. And the best time to be liquid and to be in control of your funds and to be out of debt is, we think, right now in this highly appreciated marketplace. It's a great time to sell. Use the deferred sales trust to do all of that, right? And as a reminder, you can up to 80% with the deferred sales trust is liquid and available to go out into alternative investments such as investment real estate, such as hard money lending, or developing new real estate, all tax deferred, of course, with a brand new depreciation schedule versus just the 1031 exchange, where, let's face it, the worst time to do a 1031 is when it's a seller's market and you're getting a premium price for the sale of your property, but you're having to buy back into that same highly priced, appreciated marketplace. Don't do that. Look at the deferred sales trust. Also, he talked about really outworking and outlistening and applying the knowledge which he has learned. I was inspired by that. So go out right now with the knowledge you've just a chance to glean from and apply it. Take the next step to applying it. And of course, always reach out to us at capitalgainstaxsolutions.com. Schedule a free 15-minute call so we can talk about how you can create your deferred sales trust or capital gains tax deferred wealth plan, and clarify any questions you have on the best way to do that for you. And thanks again for watching the show. Please share, subscribe, and rate, and we'll see you next time.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.